If you could afford a $3,000 a month in rent, why can't the bank approve you for a $3,000 a month in mortgage repayments? Let me show you why. Now, according to real estate industry norms in Australia, you need to earn 3 times the rent to show you can afford the rent. That's a ratio of 3-to-1 rent to income. So jumping into my table over here, rent versus owning your own home, $3,000 in rent versus $3,000 in mortgage repayments. Our first table, 3-to-1 income ratio. That means 3,000 times 3, that is $9,000 a month times 12. That's $108,000 of collective income you need to show to afford this rent for the real estate agent to approve you to rent this place. However, going to the same table, the real estate agent and the landlord does not look at whether you have HEX debt. You might have a $60,000 combined HEX debt between the two of you, or if you're single. You might have a car loan that's paying $500 per month. You might have a personal loan paying $200 per month. You might have a buy now, pay later, SIP pay after pay $150 per month. And on top of that, you might have a credit card or a few credit cards for holiday reasons that you're paying $300 per month. And this, the landlord and the real estate agent do not care. This is provided you have a credit score over 750 points. Now, moving on to the second table, owning your own home for $3,000 a mortgage per month. What does that look like? Well, the home loan will be $474,700. The rate will be 6.5 because you'll be probably borrowing with 10% deposit. At 30 years, that's about $3,000 per month approximate. Now, assuming you're on the same combined income as the first scenario, which means you're on $50,000, your spouse is on $58,000, a combined income of $108,000. Using the max servicing calculator that we brokers have, you can see from all the banks over here, I'm not going to name banks for legal reasons, you barely service the debt at $474,700, which is a previous screenshot to show you the $3,000 per month repayment at 6.5% interest rate over 30 years. Now, at this point, you guys will be probably scratching your head and go, hey, Q, you just showed me that if I can afford the rent, I can afford the mortgage repayments. Mind you, this maximum capacity at $108,000 income does not include all this shit the landlord and real estate agent ignored to allow you to rent this property at $3,000 per month. Because in the borrowing serviceability calculator, I have hidden all these debt, the credit card, the personal loan, the car loan, the buy now, pay later, right? Watch if I just turned it on. Boom. Boom, 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 all turned on, your max capacity goes down to this much. What that means is the $3,000 of mortgage repayments you thought you could afford because you're paying $3,000 a month in rent anyway, well, the bank doesn't agree with you because the max capacity dropped from $474,000 to $422,000 because the bank is taking into account your existing external debt. But then you say to me, wink, wink, shh, Q, just between me and you, don't disclose this debt when we're applying for the home. I'm sorry, I have to disclose it, but even if I do not want to disclose it, the banks have access to your comprehensive credit report, which means they know everything about you in terms of liabilities. They even know what color undies you're wearing. So taking that into consideration, even though you can make a rent repayment of $3,000 per month, even with your existing debt, you can definitely make a mortgage repayment with $3,000 per month in mortgage repayments, right? Even with your existing debt. But the bank doesn't look at that way. They'll add a buffer to your existing debt and go, hey, $3,000 per month minus the existing buffered rate of the debts you have, you can only afford $1,850 per month in mortgage repayments in our eyes. And based on what the annual banks thinks you can afford, which is $1,850 per month approximate because you have all this external debt, you can only get a mortgage of $292,700. Now, based on $292,000 of mortgage approval, to quote my Vietnamese uncle, what the hell can you buy in the Sydney? So therefore, guys, if you want to increase your borrowing capacity, get into a home that you want to today. Focus on paying down all these bad debts. For example, first of all, your car loan, your personal loan, buy now, pay later. That is the worst. Zip pay, after pay, get rid of it. Your credit card. Then maybe focus on your HEX. But even if you don't focus on your HEX, you get rid of those things, you would increase your borrowing capacity exponentially. So what I suggest you in the next 6 to 18 months, get my That Super Budget Tracker, work on reducing your debt. You'll be surprised. I've worked with a lot of clients, developed a game plan. They read my book, Keep Calm Mortgage On. They also read and listened on Spotify, The Ultimate New Property Guide, which is this book over here, The Ultimate New Property Guide, where Q, myself, helped a noob called Susan Noob get into the property market very, very fast by building a game plan to reduce their debt so that the banks open their eyes and go, wow, you're an amazing client. Here's the home loan approval that you want. Jump in the comments. Let me know if you have any other questions.